Before Lehman Brothers, before the big bailouts, there was New Century Financial. Its collapse was really the first major tremor of an earthquake that would shake the entire global economy. So today, we're going to dig into the story of the company that lit the fuse.
To really wrap your head around New Century, you have to start with this number, $97 billion. By its peak in 2006, that's the value of high-risk subprime mortgages the company was writing in a single year. It's just an absolutely mind-boggling amount of money.
But look, this wasn't just some big number on a balance sheet. No, this was the fuel. This was the raw material for a financial meltdown that went global. So you have to ask yourself, how on earth did one company rate that many risky loans, and what happened when the bill finally came due?
To find the answer, we actually have to start at the end of the story. Think of it like arriving at the crime scene, right? The moment the whole machine just ground to a halt. So, in the spring of 2007, New Century, which at the time was the biggest subprime lender in the entire country, just imploded. It filed for Chapter 11 bankruptcy, and practically overnight, more than 3,000 people were out of a job. It was this sudden, brutal collapse that sent the first real shockwaves through the system.
So how does a company get so big, so fast, that its failure can send those kinds of shockwaves? Let's roll back the clock and see just how this behemoth was built in the first place.
And the growth was just insane. It was so fast. It was founded in 1995 by some industry vets, and New Century just rode the massive wave of the early 2000s housing boom. In a little over a decade, it went from a startup to an absolute giant, hitting that peak of $97 billion in loans in 2006.
You basically had a perfect storm of conditions that made this crazy growth possible. For one, interest rates were super low, so borrowing was cheap. Lending standards, they were, let's just say, incredibly loose. And maybe most importantly, Wall Street was just starving for the high-yield investments that these risky mortgages could be turned into. You add some really aggressive incentives for mortgage brokers to the mix, and you've got a recipe for explosive and very dangerous growth.
All right, so let's pull back the curtain. How did this machine actually work? I mean, what was the product they were selling that was so wildly profitable?
At the very heart of this whole thing was this, the no-doc loan, or as people in the industry called it, a little more cynically, the liar loan. This was a mortgage where the lender didn't even ask the borrower for proof of income. You pretty much just stated what you earned and poof, the loan was often approved.
This was their entire playbook. See, it wasn't about holding on to good loans for the long haul. It was all about sheer volume. They went after borrowers who couldn't get a normal loan, approved them with these risky no-doc terms, collected a fat fee for creating the loan, and then immediately bundled them up and sold them off to Wall Street. The profit was in the fee, and the risk? Well, that was now someone else's problem. For the borrower, the pitch was a total dream, a low, affordable initial payment thanks to something called a teaser rate. But the reality? Oh, the reality was a nightmare just waiting to happen. After a year or two, that teaser rate would expire, the interest rate would skyrocket, and people would get hit with a massive payment shock that many just couldn't afford. And this is how they pass that risk along. It's a process called securitization. They take thousands of these loans, the good, the bad, and the really ugly, chop them up, and then repackage them into these complex investments called mortgage-backed securities. Then they'd sell these to investors, who, a lot of the time, had absolutely no idea about the ticking time bombs hidden deep inside.
A high-speed, high-risk machine like this can only run as long as house prices keep going up and borrowers can somehow keep making their payments. But you know how it goes. Eventually, the bills always come due.
And when it unraveled, man, it was fast. I mean, blink and you'll miss it fast. In late 2006, interest rates started to tick up, those teaser rates began to expire, and defaults just shot through the roof. By February 2007, the company had to admit its books were all wrong. A month after that, it stopped making any new loans. And by April 2nd, it was all over. Bankruptcy. But what was the final trigger? What was the single blow that brought the whole thing crashing down? Well, it came down to this number, $1 billion. This was the skeleton in their closet. As all those loans started to fail, the Wall Street firms that had bought them came knocking. Their agreements said that if the loans went bad right away, New Street had to buy them back. These demands quickly added up to over $1 billion, a sum the company simply did not have. It was insolvent. Game over.
So what's left when the dust settles? What can we learn from the wreckage? Let's talk about the aftermath, because the legacy of New Century's collapse is definitely still felt today.
After the bankruptcy, investigators came in and just found a total mess. All sorts of accounting problems and these huge hidden liabilities, like those billion-dollar buyback demands. The founders got investigated by the SEC, but here's the kicker. In the end, despite this catastrophic failure and thousands of people losing their jobs, no one served any prison time.
The official bankruptcy report pretty much summed it up perfectly. New Century was labeled an early contributor to the meltdown. And that's exactly what it was. It was the canary in the coal mine, the first loud, clear warning sign that the entire foundation of the housing market was rotten. And its failure had real, tangible consequences. It put a huge spotlight on other aggressive lenders like Countrywide and became a key case study for regulators. The lessons learned from New Century's whole originate-to-distribute model directly influenced the creation of new lending rules in the Dodd-Frank Act, which was designed to prevent this kind of thing from ever happening again.
Which leaves us with one last big thought. In recent years, we've seen a massive boom in new kinds of online and fintech lending, a lot of it focused on speed and volume. Does the story of New Century, a story of explosive growth, loose standards, and passing on risk, serve as a warning for the potential dangers lurking in our financial system right now? It's definitely something to think about.